Okay, folks, we are looking at price action model number 9. It's going to be a one-shot, one-kill trading model. Just one approach to how you guys can use this information that was taught in mentorship. Obviously, there's many different ways we can formulate an approach to trading the weekly range, but we're stalking a 50 to 75 pip per week haul on a consistent basis. Now, before we get into it, just remember that it's not my goal to teach you to expect it to happen every single week, especially as a new developing trader. Now, I know what you're thinking. Wait a minute now. I've already went through your mentorship, Michael. I'm not a new trader anymore. Well, I grant, yeah, it's probably true in a sense, but you're still new with the content. So just be realistic with your expectations. Try not to put too much pressure on yourself, and just understand that you're going to have losses. Okay, everything that I teach here, until you grow into a consistent model where you realize how little you actually have to do, there's some growing pains you're going to go through. Just try not to build them up so much that they become mountainous barriers to your underlying development. Okay, so we are keeping with the theme here because price is fractal. The stage is going to be a weekly range expansion. Like everything else in the mentorship, it's how we basically build our directional bias. We're looking at institutional order flow on a weekly chart. We're trying to ascertain the weekly direction from the weekly chart. In other words, are we going to expand to the upside or downside relative to the weekly institutional order flow? Obviously, monthly charts can help you here. So again, I'm going to preface this by saying that the breakdown and top-down analysis approach that I do in month number 12, the August content from the mentorship of 2017, that is how I do all of my analysis from the top down. And I look for those things, much like I'm going to explain here, that leads to the results that you guys see that I share on my Twitter feed. So all those trades that I share, I get inundated with, can you review that trade? Can you do this? Can you do that? I'm not going to do it on Twitter, obviously, because, eventually if I do it enough, people will start to catch on to what I'm doing. And you paid for it. So it's important for you to use the information that you learned from this mentorship to break down what you see in the trades yourself. Now, obviously, I fancy dance a little bit sometimes with my entries and exits because I don't want anyone trying to mimic or reverse engineer the things that I teach in the mentorship. There's a joker on YouTube that insists he's figured it out with a rectangle moving it around. It couldn't be further from the truth, and you all know the difference between what we're learning here and what's being shown by the people that supposedly figured out what you are learning. Nowhere near. So the weekly range expansion, that is our go-to all the time. That's our one trick pony for directional bias. Okay, so if you do your work and study on your weekly chart, which direction is it reaching for on your weekly chart? That's the direction you trade for daily bias. Will every single day, Monday through Friday, trade in that direction? No. And it's not necessary. You don't need it to do that. Okay? There's going to be times that you'll see in this teaching here where even on a weekly basis, you may get it wrong. And the week may do something that you weren't expecting. And that's typical. That's normal. That's outside of the expectations of a newbie, because when they read a book or go through a course or join a service like we have here, naturally they assume that they're going to have 100% accuracy, and that's not realistic. So I'm going to show you how sticking to the model itself, eventually you're going to encounter adverse results. But you stick with it, and you'll get right back in line with what the institutional order flow and smart money's doing with price action. So the setup, again, we're focusing on day of the week. Okay, so Monday, Tuesday, and Wednesday, we're expecting a high or low to form. Now, conversely, what we said about the model number 8, okay, where we didn't require or even concern ourselves with hunting the weekly high or low, this model we are. So we're going to touch on some things that I do that allow me to consistently find what the weekly range is going to do and where my sweet spot entries are going to be. So the pattern, again, we're working with inefficiencies. It's liquidity voids and fair value gaps. 2, liquidity runs. Now I'm going to give you some insights about that I haven't shed on any other lesson in mentorship. So let's get into it. Nothing's changed in terms of our underlying framework because it's based on a higher time frame, top-down analysis approach. We're using the weekly range expansion, and we're looking for, again, that range between the next 50 to 100 pips. So the same model we used for model number 8 for our, I guess, higher time frame premise or directional premise, if you want to call it that. It's the same thing. We haven't changed it. And if you've gone through the mentorship and you've paid attention, this is what I actually teach. This is how we look for institutional order flow, and we stick with this narrative. We do not care what anyone else is saying on Twitter or YouTube or CNBC. We don't care. Okay, we're focusing on what price action is telling us, and we're going to stick with that narrative until we are proven beyond a shadow of doubt that it's no longer valid. When is that? You'll know. Okay, when your trades aren't working out and it's just screaming the other direction. Okay, you cut your losses short and go in and see if the analysis will support that opposite direction. And that's trading. That's what goes on. That's what professionals do. But when we work off the higher time frame, we're doing that to build a directional bias. That way, institutional order flow on the daily, 4-hour, and 1-hour charts will be in sync with us. And our trades will more than likely pan out. Now, again, that's not an absolution. It's going to be the result that you expected. There's going to be adversities, obviously. We're in the lower time frame models as far as entry and looking for small moves still outside of swing trading and position trading. So there's more potential for setups, which also means there's more potential for taking an entry that's wrong. Okay, so be mindful of that. And that's why we want to limit our focus on Monday, Tuesday, and Wednesday for this particular model. The inefficiency and liquidity runs, if you have studied the mentorship and gone through it a couple different times now, it's a lot of content, yes, but you should be going through it every 6 months. Just go through the lessons, cycle through them over and over and over again, make it so you know what I'm going to say before I say it. You want it to be that redundant, because if you know what I'm going to say, that means you know that lesson. You know it. You know it by heart. The live sessions, they have lessons inside them, tucked in different places, but the lessons themselves each month, if you go through them, they're going to give you the underlying language that we use to build these models. And again, these are not complete. The intent was to introduce 12 unique models, and we build them up as we go. So in 2019, we'll go right back through these again. Each month we'll focus on one, and we'll add more insights and build it up. And then in 2020, we'll do the same thing. We'll keep building it up. And you'll see how each one of these 12 models can, over time, as an example, not that you should grab one of these and run with it and say, this is how I'm going to do it. You can, but I'm not encouraging you to do that. Okay, I want you to study them broadly, in other words, all of them, and whichever one you feel closely linked to or we gravitate towards, that's probably the model that's going to be closest to what you're going to end up becoming as a trader. Can it change later on? Yes. So be flexible in the beginning. So how much time is it going to require for that? Determine if you're going to be a short-term trader or a swing trader or position trader or even a scalper. Some of you guys wanted to be position traders, and now all of a sudden you're like, man, I can get in here a couple different times a week, scalp enough, and I'm done. And that's awesome. You know, that was the intent of the mentorship, for you to discover what makes you tick as a trader, and then focusing on those tools that will allow you to do very well doing that. But going through the mentorship, I taught two things as it relates to liquidity. One being external range liquidity, that being like run on outside double top highs and double bottom lows, and internal range liquidity, which is fair value gap, and liquidity voids, and order blocks. If you haven't picked up on it yet, what I have not disclosed until this lesson here is you want to look for models in your trading. And don't talk about this, okay? I know there's a few of you in here, and I'm going to catch you eventually, but you're sharing my content. There's things that I purposely kept back until we got into the charter membership level because they're just too good. They're too good, and no one talks about it because no one knows about it. No one thinks about it because they've never been exposed to the things that I've been exposed to. So when we look at price action and we classify runs on liquidity or runs into liquidity, they're based on two categories, two classes. Again, one being external range liquidity and the other internal range liquidity. Most of the time, you're going to find that internal range liquidity entries will run to external range liquidity. That means you're going to see order blocks, fair value gaps, or voids be your entry, and it'll expand outside of the present short-term dealing range to external range liquidity, and that is your low resistance liquidity run. Conversely, if you are using turtle soup entry style trading, in other words, fading double top highs that get ran out in a bearish condition, you can use that as your entry, and then you're going to target internal range liquidity for your exits. So we're coupling everything we taught in month number 5 for the PD array matrix and all of the PDAs as it relates to internal range and external range liquidity, how they couple together. I just gave you the decoder key, if you will. Okay, all of my trades, all of them are framed on one of those two conditions. If I'm entering on an external range liquidity, I'm aiming for internal range liquidity. And I'll explain what that is if it's not being made very clear to you yet. But if you study the mentorship, you know exactly what I mean, and you're probably saying, oh, there it is. Well, that's not all. We got a lot more stuff to teach eventually, but this right here is one of those, man, I now know what I'm looking for moments. That's what you should be having right now, because if we know that a double top, which is what we call as Candyland, when they run those stops, it's expected to be a sweep most times. So it's going to return back inside of the previous range. What's it going to do once it gets inside that range? It's going to seek internal range liquidity. It's going to go for fair value gaps. It's going to go back for equilibrium, or it's going to go to a bullish order block. And it's going to seek to recapitalize at those levels. Now, I don't know if it's going to run to the other side of the range and break out the other side. I don't care. That's why I couple it with external range entries and internal range exits, or internal range entries and external range exits. That's how I look at the marketplace. That's what makes me consistent, because I'm looking at the orders. Now, I don't have something on my screens, okay? I don't have a membership to anything that tells me this is where the orders are. So if we look for internal range entries, it's fair value gaps, liquidity voids being filled in, or order blocks. We're looking for a range to be broken, but I don't care if it continues to keep going. Once it trades outside of the range, that's where I'm looking to exit my positions or scale out if it's going to be a long-term position, which I don't long-term trade anymore. So if we have these elements understood, we now have a complete model at our fingertips. Anytime we want, we can look at any chart, any time frame, and quickly ascertain what is the current trading range, what's the higher time frames, most likely probable direction, determine where those inefficiencies are and imbalances. And the difference between that is an imbalance. If we have a market that rallies up higher, it's going to create many times a fair value gap or a liquidity void where there's one or a couple big up candles. And that's a buy-side imbalance, sell-side inefficiency. Okay? Knowing that, it's the same thing. You're saying the same thing when I say those things, because I notice when I go through my notes, or if I look at something when someone asks me a question, they'll say, what's the difference between when you say it's running for buy-side liquidity or if it says a buy-side imbalance? What am I saying there? It's the same thing interchangeably. It depends upon how I'm looking at it. So it means the same thing, and it may be a little bit confusing for you, but just know that the characteristic of that price action, when price runs up hard from, say, a significant intermediate term low, and it rallies quickly, it will leave porous price action in the form of inefficiencies. There's not been a lot of offers in there to pair up sells. It just keeps bidding higher, 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 higher. And those gaps, which you don't really see, they exist. So it's a buy-side imbalance by nature, because it's too much of buying, and IPTA will want to rebalance that with sell-side delivery. So it's inefficient in the sense that it's without enough or a efficient means of sell-side liquidity in that big run-up. So a sell-side imbalance is the opposite. The market runs down quickly, and there is a buy-side inefficiency. So there hasn't been enough bids in there while the market just keeps dropping, 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 dropping. It's too many offers. So IPTA will want to go back up and rebalance that. So it's important that you understand that there is an element that may have caused some confusion throughout the mentorship. It's just, when I look at it from two perspectives, and it depends upon what I was saying at the time when I was saying it throughout the mentorship. Because if I'm looking at something for a purpose of taking profits, and I'm using a fair value gap or liquidity void, I'll be looking at it and characterizing that move into that level based on the purpose of it rebalancing, okay, and removing the inefficiency. But it's still the same thing. A buy-side imbalance is a sell-side inefficiency. A sell-side imbalance is a buy-side inefficiency. It's the same thing. There's two halves of that story, okay? Or you want to say it like this, there's two sides of that coin. It's the same coin, okay? We're talking about the same thing, but there's two elements that make up price movement, the bid and the offer. So from a liquidity standpoint, we have to understand what is the purpose of price going to that level again. Is it going down there to rebalance, to pick up more orders, and that fits the narrative? Or is it going down there to offer means of offset distribution to allow smart money to get out of the move, and then we have to wait to see if it's going to consolidate or continue to break through? Those are the things that we have to balance out, and the narrative is determined by more study. So let's go into, again, the charts here. And these are the same charts exactly as model number 8, but I'm showing you from a fractal standpoint how we all are looking at the same chart anyway. Every single one of us is looking at the British pound, the euro, the Swissy, the yen. I hate it. Canadian dollar, loonie, whatever you want to call it. We are all looking at the same thing every single day, every single week. But because of the type of trader you're trying to be or aspiring to be, and you may not know what that is yet, still, it's normal for you to still be unsure because it's a lot of content and you have a long career ahead of you and you don't want to rush this part of it. But when we look at price action, all of us are going to see something different. Even though we're seeing the open, high, low, and close the same, we will all internally digest this uniquely different. And it's a startling revelation when you take a step back and you look at it like that and say, okay, wow, it really is true, because there's thousands of people that are learning from me. And all of you can sit down at the chart and come up with a different way of trading it, and it still would be profitable. And it would completely go against many times some of the things that other traders in this group would be doing, and they still would be profitable. So it's a very fascinating subject. That's why I love price action, because it allows us to see things in a way where we can manifest what we hope to have and manifest our dreams right through our visual interpretation of price action. Because then what we see in that, we can use that to manage money. That money hopefully yields a return, and that yielded return can be compounded over time, and that is the vehicle or the catalyst that takes us out of the rat race and puts us into a lifestyle that we want to have. All of us are going to do it differently. And I have changed hats throughout my 26 years of the markets, and I've not consistently stayed one thing. I've always evolved into something different, new. And I have found that I am a weekly range or day trader. I can scalp like nobody's business, and that's been evident, shown on Twitter this year. But I don't like being in the charts that much. I only do it to show off. Some of you like that. This model, one shot, one kill, is designed to capitalize on the weekly range. We're not trying to get in there and nickel dime the market. We really want to try to get as close as we can to the weekly high, sell short there, and cover close as we can in the lower 1/3 of the weekly range or expected weekly range, and be content with that. Okay, our objective is looking for 50 to 75 pips. I'm going to go through the exercise that I go through every single week. This is exactly what I do. I don't do anything other than this, and this is basically the model I do. So when I give you my weekly commentary, I'm doing this very thing. Okay, so you can use it as a drill each week. Try to do your analysis before, when we go back into doing our weekly analysis after the holidays, when we do our Monday uploads. Try to have your analysis done over the weekend, so that way you can anticipate rather what I'm going to say. Now, you may not say verbatim what I'm going to actually say. Obviously, that's not realistic. But the general theme of what I'm expecting, you're going to hopefully grow into knowing what I'm going to say. This mentorship is not meant for you to hold my hand and me hold your hand forever in perpetuity. It's not what we're doing. Okay, I don't want a codependency. I want you to say, I am so thankful as part of this. I am ready. And spread your wings and fly. It doesn't mean not come in here and hang out. That's what the membership's for. But I don't want you leaning on every word, okay, and waiting on bated breath. What am I going to say about a market? You shouldn't be thinking that. None of you should be thinking that. You know, you're charter members now. You need to be more responsible and independent in your thinking, and be okay with taking a loss. That's where your lessons are going to come from. Your greatest learning is going to come from those times where you thought you had it right, but it didn't happen. And I didn't get here without having a lot of losing trades, lots of them. And every one of them, those little cuts, they heal. And the tissue that is replacing the normal flesh, it's thicker. It's scar tissue. It's a little bit different. It's harder. And you become more callous to all these types of things over time, and you become seasoned by it. That's what professionals are. They're not influenced by the minor or short-term fluctuations in their outlook on the marketplace, because they know consistently over time they're going to be more right than they're wrong. And that's the mindset I'm trying to promote here. So if we're looking at the same model here, same price action fractal, we have Monday, Tuesday, and Wednesday. And the buy stops that was shown on December 3rd, that was the objective to be ran. Everything that was shown in model number 8 is insightful, and it complements this model. And I did this presentation with this in mind, because I went from the short term, trying to get 25 pips once a week, okay, now to we're looking at the one shot, one kill, where we're trying to get the weekly high and the weekly low. If we don't get it, what is your contingency plan? Use what I taught you in model number 8, or what I end up teaching you in the scalping model. And I don't know off the top of my head what number it's going to be, but it's in a later lesson than this. It's one of the 12s towards the end. So we have an approach to capturing what we're hopefully going to see as consistency over time. And there's going to be a model for you to follow, because everyone's asking, well, when do I do this? And if this doesn't happen, what do I do? You drop down in the models. That's why it's important for even a position trader. Okay, if you want to be a position trader and you miss your entry, okay, you had a limit order and it gets short and it didn't trade to it, you're going to sit there and wait for it to keep on trading and regret all that? Or are you going to use other models to get you in sync with the marketplace and still hold for that longer term position? That's the benefit of learning all these. And some of you are trying to wash your hands of the scalping model or the day trading model because it doesn't fit your unique personality. And I get that, but you need to understand it, because that's how a professional will encounter and engage the marketplace. If their longer term models don't provide them the entry points, what's left? They just don't trade? They just miss the opportunities all the time? No. If you know a long-term move is going to happen, and if you look at what we've been doing here, we're framing all of our trades in the direction of the weekly expansion. So we have a unique higher time frame perspective on every trade we are setting up. So we have that element there in all these models. If we are going to miss a swing trade or position trade or even a one-shot, one-kill, before we get into the nuts and bolts of this teaching, just know that you can use what was taught in model number 8 to get something off of the week. That way you don't have, a complete missed opportunity. Because if you miss the weekly high, well, from one-shot, one-kill standpoint, you missed the ideal entry. But it doesn't mean you've missed profitability or potential profitability for the week. Who cares if you only get 25 pips? It's better than missing out. Or if you take a loss and you get stopped out, you can use model number 8 to help mitigate that loss that you used trying to trade a one-shot, one-kill model. Think about that. You weren't thinking about that, were you? That's the purpose of having a multi-approach or a multi-pronged approach, if you will. When I was back on America Online in the 90s, I taught Trident, okay? And it was like a 3-pronged approach where I was always able to do something. And that mindset started in 1996 for me, and it allowed me to always have some means of capturing something before Friday. Now, it sounds like overtrading. It sounds like forcing an opportunity or forcing a trade. And to the uninitiated, that would be, probably very close to reasonable. But I'm not forcing anything. I'm adapting. And that's what we have to determine. If we're going to be a short-term trader like this, using one-shot, one-kill, we do not want to feel trapped in the sense that that's the only way we can trade. And because you didn't like day trading or you didn't like scalping, therefore, you just missed the boat. I'm just going to stay out the rest of the week. And if it's Wednesday, you missed it. Well, if you missed the trade on Thursday, what are you left with? You still have something on Friday. Don't let opportunities slip by. If you have drawdown, try to mitigate it. Don't force it. Try to mitigate it. You don't have to get all of it back. Just get some of it back if you can. If it's questionable or if you're just completely opposed to it emotionally, psychologically, getting back in, it hurts you, then stay out the rest of the week. That's how you determine that. But I taught enough in the mentorship how we mitigate losses, how we build small accounts up from nothing and keep doing the same thing over and over again. But in this lesson, the importance of understanding all the other models or approaches to trading using my concepts is that it allows you a multi-dimensional approach to engaging the marketplace and not just simply relying only on your one tried and true favorite bread and butter model. Because your bread and butter model is going to miss opportunities because you're going to get the entries wrong or you're going to take a loss. So what's the protocol for that? You need to determine that. What is it going to be? Is it going to be you're going to stay out the rest of the week and regret when there's another move that you could have done or mitigated the loss? Or are you going to say, okay, well, I'm going to adapt and say, okay, I can't do one shot, one kill because we've already missed the ideal entry points. So I'm going to drop down into a scalping model. Whoa, now you're evolving. So you're not putting walls around yourself and limiting your engagement. You're allowing yourself to be flexible in working with what the market's given you through time and price. So it's important you understand that. Also, the benefits of me teaching these multi-approaches is that when we want to move our stop, one of the lessons that you probably didn't pick up on, when you see the lower time frame trade models go to levels where there would be targets, for instance, if a scalping model or day trading model trades to a objective, for instance, the sell stops shown here, that's the only time you would be moving your stop loss on a one shot, one kill. Oh, now we're getting the gears turning, aren't we? See, everyone's asking questions that I told you throughout the mentorship. Wait, all these things will be given to you and they'll be understood. But you can't understand it and you can't appreciate it until you learn all of these things. You got to go through all the models. You got to look at all the different opportunities to trade price action, and then you'll see how they fit together. Everything is fractal, yes, but it's also modular. So what effects that the smaller time frame has and the smaller models are, they allow us to define objectively, not through ambiguity, not through guessing. Well, when do I move my stop? Well, did the lower time frame models take you to a position where they would be profitable? Because if that happens, they're probably going to have some retracement, but it's reasonable to have that retracement to a certain level. Knowing what those conditions and characteristics are by knowing the smaller time frame price action models like scalping and day trading, when those occur, when they're profitable, that's when you want to move your stop loss on a one-shot, one-kill. You do not want to strangle the trade. And the perfect example is this Wednesday staring at you right now. If you were going short in London of December 5th, there's the double highs, ran on the buy stops, and then you have an optimal trade entry right in here. Okay, you can sell short there. Fair value gap right in here at the bottom of a bearish order block. It's right there in front of you. You know these things. But where's your stop going to be? It might be somewhere up here. But as it drops down, you're going to hurry up and jam your stop loss to break even. If you do, and you're trying to trade the weekly range, this is what happens. You can have this happen to you, and you get knocked out of the weekly range expansion before it actually happens. So when do you take your stop and bring it down to a logical level? When a scalper or a day trading model is profitable. So what does that look like? We have equal lows in here. They don't get ran until this day here. But look what's happening. We have a run below the equal lows right out the gate. What are we looking for to give us confidence that institutional overflow is bearish? We want to see rallying, rejection, and trade lower. So this initial move down here, while it is cleaning up these equal lows, that would be an area where we can take profits if we're a scalper from previous day's Asian session or in the late New York hour. And here going short, this could be an area where we can take some profits. Okay, then we can bring our stop down to just above the highs, but it would have to be above this high or at that high, allowing for you to swing the curve. And then once price trades down to this level here, then and only then was one shot, one kill stop loss being brought to a break even. And then you leave it there. You do not micromanage your stop until you get into Friday. That's when you want to start really being aggressive about trailing your stop loss, because if it starts rolling for you in here, you want to be chasing it down, okay, moving your stop loss tightly, aiming again for Thursday's low. So it's important that we don't try to be so conscious of being profitable that we remove the likelihood of it actually unfolding because we're too afraid of being stopped out. If you're afraid of taking a loss, it's going to prevent you from taking a gain. It sounds like, it shouldn't be like that, but it's the truth. If you're afraid, it will make you do things that will prevent you from being profitable. So how do we go about this where we don't become emotional, we don't become psychologically overcommitted to only the profit side and not give the market enough room to move? Understanding all of the models from the lower time frame to the higher time frame, and from the higher time frame to the lower time frame. That's why when I do my analysis, I do both directions. I go from the higher time frame down to the lower time frame, and then I do it again from the lower time frame to the higher time frame. If they both agree, or if I have some sticking points, then I know where I'm going to have to study and determine what it is I need to be focusing more on, because it may be something that I missed from a top-down approach that I see from a bottom-up approach. The long and short of it is you want to be able to be flexible and use the other models to help get you in a trade if you've missed your ideal model's entry. And also by having the lower time frame models, scalping, day trading, those types of price action models, if they are moving to areas where they're profitable, and if you were trading them where you'd be getting out of the trades, only then do you adjust the stop on the higher time frame, one shot, one kill, short-term trade. You don't want to be chasing it down lower than that because you have a range that you're still inside of. For instance, in here, on Thursday, when the price starts to trade off, You do not want to be trailing your stop loss. Everybody does this, okay, in retail. Everyone does it on Twitter. If they're sharing their charts, you see it. Look at everybody that shares their charts. Go back and look at examples that you know that have panned out better than what their trades did. You'll see them jamming their stop loss all the way down in here before the stops have been ran. That's not what you want to do. The liquidity run has yet to occur until here. So when this occurs, then you know that we could potentially see a bounce, but not before it runs to the liquidity. Remember, external range liquidity entry, then internal range is offered again as an entry. But if you use external range as an entry, what's it going to be reaching for? Internal range liquidity. What is that? You have bullish order block here, then it bounces. What's it trade up into? Well, where are we at now? We're inside the range. What range? This low and this high. So what's it going to trade to? Internal range. Fair value gap. There's your entry. Sells off again. This entry pattern here, what's it going to offset at? Where's the offset distribution? The sell stops. We use the internal range entry here. So now what's it going to do? Remember the opposing liquidity profile. External to internal, internal to external. The move originates here, internal. It's going to come to terminus with external below this low here. How far is it going to go? You know this, 10, 20, 30 pips. That's the sweep. Then what's it do? It rebalances. Now, this could very easily come all the way back up inside the range, but if you've adjusted your stop loss to lock in something, you're not concerned about that. But also, if you're doing one shot, one kill, down here on a lower time frame model, like day trading, this is a day trader's model here, if we see that and it trades below here, aren't you inclined to take something off that one shot, one kill to fund the trade? Think about it. Why wouldn't you? That's exactly what you're supposed to do. So you can see how all of these models, they complement one another, but you can't just say, I don't want to be a day trader, I don't want to be a scalper, so I'm not going to study those notes. Or don't send me emails questioning, okay, I don't really feel like I'm going to be a scalper or a day trader. I think I'm going to be a swing trader. I like the daily chart. So is it better for me to just not look at those other trading models or those other lessons? No, absolutely not. You're robbing yourself of understanding. It's essential. You can't learn from me and cherry pick. You can't do that. You have to learn it all. And the only way you do that is complete immersion. When that occurs, when we have the big picture view, if you will, once this occurs and you have that total landscape in front of you, then you have an informed perspective. Then you're in the realm of smart money. Smart money is aware of what goes on in the lower time frames. They're aware of what's going on in a intra-week basis. They're aware of what's going on the monthly basis. They understand what we're doing in terms of the last 6 months trading range. We understand where the market may reach on the monthly, quarterly, and yearly charts. They know those things, okay? But they aren't on social media talking about it. Neither should you. But you have to have that perspective in mind when you do your analysis, because these other models, when they are profitable, they are your triggers. That's your moment to say, okay, I'm not day trading this, but it went to a day trader's profit objective, which is a 20, 10, or 30 pip sweep above this, below this low. So what does that mean for your unique trade? That means manage the stop, because now we've ran into new liquidity down here, and we can be wrong. Think about what I just gave you. I taught you trade management here. I taught you entry strategy and exit strategy without actually saying here, 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 here. You have to know it conceptually. This is the model's purpose, okay? Each one of these models are conceptual foundations. We build on these as we go further along in the membership. But it's important for you to know that the lower time frame models, while you may not be attracted to them or looking to utilize them as your go-to or bread and butter setup, they are very helpful in terms of trade management, in terms of when to take profits. When do you scale out of a trade, Michael? When do you take profits? I just taught you that. I just taught you. These are the lessons that I told you when you were coming up through the mentorship each month, sending payments and asking questions before you were supposed to ask them. I will teach you in future lessons, but you can't appreciate them until you have all of the other content behind you. So now you can go back into those lessons and say, okay, Michael said that if we're one-shot, one-kill traders, short-term trading, I can move my stop here. Go back and you'll see those lessons are vague for a reason. People are quitting. I'm not giving you everything in the first couple months, and not all of it was given in the first 12 months either. The framework is there. You know how to go back and get to that information and get to the nuts and bolts of what I'm saying now, because now I can talk in a really relaxed, leisurely way. And it makes sense to you now because we have that same language. You can go back and get more information. Oh, yeah, he talked about that in short-term trading. He talked about that in swing trading. When do I move my stop? How do I manage my stop, Michael? When do I take profits? How much of a position do I take off my trade? I just gave that to you here. That's why you have to go through all the content. If we look at this objective of 50 to 75 pips, let's go into the charts and pull out some more insights, and then we'll close this lesson. Okay, so let's take a look at this now. We've looked at the weekly chart in model number 8 for the dollar Swiss. The equal highs in here. This is the external range entry that one could use for the one-shot, one-kill. We could do that on a position trade entry basis as well. We could do it as day trades. We could do it as scalps. Okay, but if we know these equal highs are likely to be rated, which we talked about before the fact, once it trades to those and clear those highs out, the likelihood of it continuing up can happen, yes, but most likely it hasn't. Why? Because it came from such a low point here off of an order block, came all the way up. So what did it do here? We traded from internal range liquidity. What's the range, Michael? The low to the high. So it traded all the way down, hit a bullish order block. So what type of liquidity is that? Internal or external? It's internal. So what's it going to reach for now? External range liquidity. And that's what it does here. That's your offset distribution. If it is offsetting anything that was allowed to be purchased here, it has no awareness of how much is actually going on the trade or off the trade. It's just gyrating to these price points. So if we know that it's going to hit the external range liquidity in here, the likelihood is it can come back down inside the range. Now what's the range? This low to this high? That's one of them. But what's the current dealing range? This high and this low. So we were inside of the range right here, and then we expanded outside of it here. And then one more week here, and then one more week for good measure and punches through. What did it reach for? The equal highs over here. Again, disregard the wicks, these equal highs. So inside of this run up in here, the likelihood is that we're probably going to see it return back inside of the range. What range is it? This low to this high. So if we were looking at external range as an entry, even if we don't take the trade, our analysis tells us that it's going to reach for an internal range liquidity marker. That's going to be bullish order block, liquidity void, fair value gap, or old highs. That's what I gave you in model number 8. So all of this storyline in here fits the narrative once you understand after external range has been put in motion, internal range liquidity is going to be the target now. That's not to say that it can't go lower and hit external range liquidity below this low here. But we have to, like I taught in month number 5, the PD array matrix, you have to go in the order of the PD arrays. Which ones exist? Not all of price action fractals are going to have every PD array. So in here, we can define where the imbalances are, the inefficiencies, and this is a buy-side imbalance, sell-side inefficiency. All of this is an imbalance, too much buying. So that's, if we were on a teeter-totter, okay, children's playground apparatus, everything's on the buy side, okay, and The other side, the sell side, doesn't have anything. So it's an imbalance. It's inefficient in the sense that it didn't offer enough sells in here. So price will most likely want to come down and rebalance that with a range trading back down to it. So this is the example I was referring to, external range to internal range to external range. Go back through any time frame, any chart, any market, crypto, oil, currencies, stocks, CFDs, bonds, commodities, it does not matter. If it trades, it will do this. This is what market making blueprints are as far as I'm concerned. They do this stuff all the time in everything. That's why I'm consistent, because I'm not trying to buck the narrative. That's the storyline these markets work on. So who am I to try to change it or try to do something outside of that? It's going to keep doing what it's doing, not what I want it to do. So I don't have any imposing of my own will on it. I'm trying to get in line with it, and that's all we're trying to do here. So let's go into a lower time frame daily. And let's go to the other chart here that has my levels delineated. We use the same thing. Consequent encroachment, which is the midpoint of a fair value gap or inefficiency. That's what this is here. That's what you see, that sensitivity there. I'm going to use this chart here. Everything's on it. We're going to drop down into a daily. Okay. So now when we get into a daily, we can see a whole lot more definition in terms of the delivery or inefficiency. Price creates that run here. This is that additional little ramp up in here, and price breaks down. When do we get our market structure break? From this perspective, on the daily, we don't get it until this low is violated. That's here. Once that occurs, price trades back up into these levels right here. Now, what did it trade up into? What's the significance of this area right in here? What's actually happening? Well, we have this down close candle here right before the up move. So isn't that the breaker? No, it's not the breaker. We have this down close candle. Even though we have a lower low here and a lower low here, this candle here went down the most. So where was sell side delivery originating from? This candle here. Even though we had it in here, this candle's inside of the range of this candle. So this is insignificant. It's this one. So if we have that understood, using our rules, here is our breaker, bearish breaker, after the break in market structure, after equal highs have been taken. See, that's what's missing from everyone that's gone through free tutorials. Everybody has a YouTube channel now. Yeah, they all have a YouTube channel and they're teaching breakers. And occasionally I'll go on and I'll make a little snide remark about it. That's not right. But I'm not trying to poke fun to be mean. I'm just being honest. You know, some of them just don't have it, and they're trying to promote it because, you know, whatever. Long and short of it is, there's rules we have to go by, and we taught it in Mentorship. So here's our breaker. Price trades out. Look how many times it spends there. 1, 2, 3, 4 times, and then gives up the ghost. Then what's it do? It trades right back up here. Does it run these equal highs now? No. It doesn't need to. Why? Because it's already mitigated all of this movement in here. There's no necessity for these equal highs to be ran. Oh, think about that. Because everyone else would have been on Twitter, or everyone else would have been saying, look at these equal highs. We're going to run these equal highs, and we're going to expect that to keep going higher and run those. What's the narrative? Stops, been taken, breaker, mitigation, mitigation, mitigation. Can't do it. It's already showing you that it's respecting the breaker. There's underlying narrative of a sell program in this particular currency. So price starts to decline. We have internal range liquidity as an entry here, external range liquidity as an entry here. Okay. Each one of these vertical lines is a full month. Every one of these bars is an individual day. If we want to look at the perspective of one shot, one kill, if we look at the perspective of this breaker offering real resistance, okay, because if you're looking at classic support resistance, where do you draw the line at? You see, it's a fallacy. It's silly. You have to understand what has been happening in the marketplace and think outside of the candles. We don't look at candlestick formations. We look at what price has done. Buy stops have been cleared above equal highs on a weekly basis. Distribution came in. Market structure break. Last down closed candle, wait for the up move. This is our breaker. Smart money's going to want to mitigate right there. Boom. That's how you draw lines to support and resistance. That's real support and resistance because it's based on institutional order flow. That's not taught in books. It's not taught anywhere but here. When you have that understanding, we know that if the market's not wanting to go higher from this price point in here, every one of these days in here, where's it wanting to go? Well, we have these levels delineated from the weekly chart. But look at the daily. Forget the weekly chart for a moment, okay? Not to remove its importance or significance because it's greater than what I'm about to show you here. But when you couple it with what's being shown in the daily chart, it refines it even more because everything now has a lot more clarity. We have a breaker here. We have a low, a high in between to the new low. Sell stops here, relative equal lows as well. So this candle close 97.48, that could be the actual down move it trades into, and then we could get probably a bounce there, maybe. Doesn't have to, but that's an objective from where we are right now, and that's range. It gives us a range to work in. Also notice that we have very clear and discernible fair value gaps using the daily, and it's still fitting the narrative that we've outlined relative to the weekly chart. So there's a fair value gap right here. We have one between this low and this high. So I'll just carbon copy this. Swing that up here. Right there and there. Okay, so we have a fair value gap there. Notice that the fair value gap that's rating on the daily, it sits directly, perfectly over top of the weekly consequent encroachment, which is the middle of the fair value gap that's defined in the red lines. That's a weekly fair value gap or inefficiency. So we had only buy side offer here, and the market's going to, well, we saw it come down here to consequent encroachment here, and look at the sensitivity there. Now it'll want to probably come back down again and completely close in all of the weekly, but you have to be mindful that it could bounce on that 97.83 level, which is what? 97.85 calibrated because we're above it right now. Trade down to it. Remember, that's our rules. Work to trade to and allowing to 80. So there's a 3 pip variance there. You going to lose sleep over 3 pips? I can't help you if you do. And this is a probable downside objective too, which could dip into the breaker over here, not stop on its close, but get into the breaker a little bit more, and it would be rebalancing this buy side imbalance and sell side inefficiency. Okay, so it's a BISI or SIBI. Okay, the acronym for that. Nonetheless, it's just a fair value gap, but you have to understand what it's doing and what's the purpose of going down and filling it, because that's what makes the narrative useful. So let's go into a 4-hour time frame because we utilize that for one shot, one kill. Okay, so we have that breaker here, and now we have a week worth of data. So every one of these vertical lines represents a full week's worth of trading, and we can see how the breaker gives us a storyline. So we're bearish to what? Till we get down to this first red line. So every week we could be looking for one shot, one kill setups. Now this week here, on December 7th to the 13th, we can't find successful shorts there because it's coming back up into an old area of institutional order flow. All of this range in here had to be filled, and then maybe it could have dropped from there, but look what happens. It runs one more time. Let's be realistic. This is what's going to happen to you. You're going to get burned. If you trade enough times, it's going to happen. So this is where you would have a loss. trying to follow the model every single week, looking for shorts, trying to sell short on a Monday, Tuesday, or Wednesday. It doesn't offer it to you here. Maybe you might get a little bit of scalping here. Okay, maybe you would have reduced your stop a little bit, maybe, because we went down below low here, intra-week. Maybe you would have adjusted your stop, but you still would not have seen the trade pan out like you would have expected, like over here. Now we have price at a premium again. Why? Because we have this high to this low. I don't need to draw optimal trade entry here. You can see clearly we're above will be the middle point of that. Turtle soup scenario again. Another high also, rallied through. Price breaks down. What does it create? Sell side imbalance, buy side inefficiency, liquidity void. How do we define it? Up close candle. Last time buy side was offered before this candle cut through to the downside, and we refine it to this candle. I really hate when they get crooked. There we are. So this is our range. Now watch, here's where the magic happens again. Consequent encroachment. The range defined here. Boom. Look at the sensitivity. Bang. Hammered. Again. Boom. Hammered. Drops down. There's magic in this, folks. Trust me. So when it hits these levels, we understand that it only needs to get to the midpoint. It doesn't have to completely close it in. This is the reason why I like to trade the bottom of the gap and allow my stop to go through all the way to the other side of the gap. That's how I trade them. I don't try to get in here and nickel dime it. If I feel absolutely certain, like if I look at it and it's live, if I turn a chart on and it's live, or if I just happen to catch it as it's coming into this area here, then I'll do a limit right at the midpoint and try to get that. And that's many times what you saw back on baby pets when I was showing examples where I was getting the highs and the lows of the day. It was using this technique right here. So we see the distribution cycle come in, sells off, boom, down into consequent encroachment on a weekly gap. Then we have sensitivity there. Price rallies away from that. Let's drop down into an hourly chart. We'll get a better perspective. And we'll see how we are operating from external range to internal range and internal range to external range liquidity. Okay, so we have volume imbalance here. You guys know what that is. Fills that in. Then distribution comes in on a Monday. Tuesday, we rally back up into another volume imbalance. Again, it's the bodies that don't, even though there's wicks in here, we want to see this separation. When that occurs, that's a volume imbalance. We will look for that to get rebalanced. It does it exactly to that, just like a typical bearish and bullish order block. Right in here, the butt end of that creates the same kind of gap. It's like a micro fair value gap. Hits it, fills it in beautifully, sells off. So we have this volume imbalance. Is that going to be external range or internal range liquidity? Internal range, because we're inside of the high and the low here that we retraced inside of. Price trades lower into what? What's the protocol? The signal generates or the origin begins, the origin of the move rather, begins at internal range liquidity. So what's IPTA going to seek now? External range liquidity. Where is that? Below the low here and below the low here. Where does it go? Right below the low. So what happens next? Price rallies back up. Wait a minute, what's it rallying back up to? It's closing a fair value gap that's created from this candle here that stopped and started to drop down this low to this high. Fair value gap. Right there. And the last up close candle, which is what? Bearish order block. Is this external range or internal range liquidity? Internal range liquidity. So if we expect price to drop off and we start to see it here, where's price going to reach to? Again, origin of the move is internal range liquidity. Where's IPTA going to go next? External range liquidity. What is that? The equal low here and here, Candyland. Well, wait a minute, how far is it going to go? Well, 10 pips, 20 pips, 30 pips. The low here is the close, which is 98.41. 10 pips below that would be 98.31. 20 pips would be 98.21. 30 pips would be 98.11. Price trades down to a low of 97.91. So we go even beyond that. It went basically, good grief, what is that? 41, it went 50 pips exactly down. But more specifically to that consequent encouragement on the weekly fair value gap. Internal range to external range. External range to internal range. Remember, we went below these lows here and here. So if we're going to buy below this low, if we're scalping, okay, for instance, the entry's on external range liquidity. So where's the offset distribution going to be? Or exit? At an internal range liquidity. Boom. You see how both sides of the narrative can be seen from an ICT student, and it's still profitable. When you have this information understood, it literally is like you took that limitless pill in that movie, because all of the opportunities that you've never seen before jump off the chart at you. And you never worry about missing moves. You don't worry about those things because there's so many opportunities. Look, this is an hourly chart, okay? An hourly chart. Now, obviously, let's just be realistic. This is on all holiday volume. But look how much sensitivity there is in the holiday. All right, so let's take a look at the one shot, one kill using the elements that we discussed here, external range to internal range and internal range to external range liquidity runs. Price trades up into a higher time frame breaker, which is what's being shown here. Several different times it tried to get up in there, remember, on the higher time frame chart. When we see the run, we have a higher high here, price breaks down. So what is it doing? Trades into internal range liquidity here. Price runs one more time. What's it going to run from? Internal range liquidity to what? External range liquidity. That's why you get that higher high here. So if it runs through there, so now we have external range liquidity, which is going to reach for internal range liquidity. So we have a run down. What's it fill in? Initially, it's this little gap right here. Then we get a bounce. Creates one more optimal trade entry. Okay, so now we have what? Price returning back up into internal range or external range? Internal range. We're inside this range high and this low. So the point is the beginning of the move starts with internal range liquidity. So where's it going to reach for? External range liquidity. Relative equal lows here. Price drops down. Boom. Liquidity here. External range liquidity, what's it going to reach for? Internal range. Where's the internal range liquidity? Fair value gap right in here. Let me zoom in a little bit. Fair value gap right here. Okay, from this low and this high, beautiful distribution cycle right there. So this is what? Internal range or external range? Internal range. So where's if they're going to take price? To external range liquidity. Below this low. Internal range to external range. Okay? Every time frame, I don't care what time frame you look at, it will be there every single time. Now, all you need to do is determine what is your unique model going to be. Are you an internal range liquidity trader for your entries, or do you want to be external range liquidity? Now, I'll be honest with you, most of you are going to want to be internal range because you feel safe trading order blocks and fair value gaps because for whatever reason they seem easier. They're not any easier. They're the same. Okay, the folks that are gravitating towards external range like turtle soup and entries, they like those because they understand a run on equal highs and equal lows generally will create a return back inside the range. And they don't like internal range liquidity because they think, well, how do I know it's not going to go through that order block? You see, so the camp is still divided if you separate everybody in a room like that. The same arguments one camp will say supports their view is the same view that they have on the other side. So don't try to alienate one another or feel like you aren't on the same level as someone else that may be in the mentorship forum sharing ideas or commentary about what they're doing, maybe using the forum as their their journal, if you will. And if they're showing consistency, don't be upset with that because it may be against what you're doing. They have just found their niche. So that's what you're supposed to be doing. That's the way you're supposed to grow into it. But there's no advantage over one or the other. Like, it depends on what price is showing me. And that's what I showed you here. We do not need to be one-sided. The ideal scenario is you want to be able to see the market on both sides, internal and external range liquidity. Because whatever the move starts from, internal or external, it's going to the opposite side of liquidity. And you don't find that in books. Until next time, wish you good luck and good trading.